We are on NISM certification exam 5B Mutual Fund Foundation, and we are discussing commodity asset class under the heading asset class, and this is part of chapter 1. Now, when we talk about commodities, what comes in our mind? Commodities means something called as spices, food grains like wheat and rice. Spices means like pepper, lal mirch, haldi. These are the spices, and food grains like wheat and rice. Pulses like tur dal, arar dal. These are pulses. Petrol, diesel, nickel, gold, iron ingots, silver. These all are commodities, and that is the reason they are grouped together under an asset class called as commodity asset class. When we group assets or investments or assets in which have the same characteristics into a family called as an asset class, why they are grouped in an asset class is because they have the same qualities or properties. That's why it becomes an asset class. So first property which comes in our mind when we talk about commodity asset class, they are the they are the material, or they are the assets, or I will call it not assets, they are the material which are consumed. When we say consumed, they are consumed either as food like agriculture commodities like spices, food grain, pulses, even livestock commodities are there, which is sold, and they or their raw material or their production like milk, other things, their derivatives from that is consumed. So they all come under the agriculture commodities or livestock commodities, as the case may be, or they are the raw materials for finished goods. For example, iron, cotton, other metals like zinc, copper, crude oil, energy like electricity, natural gas, they all are consumed to make some finished goods, or they're consumed as service. Like electricity is used as a direct product, or cotton is used to make fiber, which is used to make cloths and other usage. Metals are used for making cars, aeroplanes, and many millions of other products. So they all are raw materials, but the point is all commodities are consumed. That's why they are called as commodity. That becomes point one, and that's why all these material are clubbed together under the asset class commodity. Most of them are not used for इन्वेस्टमेंट. अधिकतर ये इन्वेस्टमेंट के पॉइंट ऑफ व्यू से नहीं यूज किया जाता है. और कारण क्या है? द पर्पस इज दैट दे आर ईदर पेरिशेबल. Perishable means they get spoiled, like fruits, vegetables. This is all agriculture commodities. They cannot be stored. Like wheat cannot be stored for very long time. They will get spoiled or can be eaten, or there is a loss of because of the rodents or disease or other things. So they are perishable in nature. And then there is a storage problem. Since they are physical commodities, they are physical assets, they are real assets, so they need space to be stored. So a lot of space is required for their storage. And then there are other difficulties which come into picture, like transportation, like other logistics issues like permits. These all are the problems in handling commodities. That's why they are not generally used as an investment product. Similarly, there is something called as commodity derivatives. You will ask me a question: why commodity derivatives cannot be called as an investment product? They are traded in the market. They have a price. They form trends, and the trends are traded. I will call them as not as investment product. But before that, I want to explain what a derivatives are. Commodities are generally have derivative product, have derivative contracts called as future contracts. So this is how commodities are generally traded. Their price are formed in the futures market. What is a future? Let's take an example. Today we have to buy rice, and it is at a rate of 800 rupees a quintal. So today I will get into a contract that okay, I am ready to buy rice at 800 rupees a quintal, and however I will after some days, say 30 days, I will settle this contract. Settle this contract means after 30 days from now, I will give you the money and you give me the rice, whichever which I have bought from you. So this is called as settlement of the contract. That is mandatory. So you have a 30-day period to either exit out of this contract or to arrange your finances and other things to settle this contract. After 30 days or in between 30 days, suppose the price of rice goes up to 890 rupees a quintal. This is the market price. And your contract price was 800 rupees. You bought it at 800 rupees in, you are not physically buying it at that point. You have contracted to buy it or agreed to buy it at 800 rupees on this date, on today. And within 30 days or by the end of the 30th day when the settlement is happening, the prices goes up to 890 rupees. What you will do is you will buy at 800 rupees and sell it in the market at 890 rupees, and you make money at 90 rupees per quintal. This is for example. These are not genuine rates. They are not even related to market rate. I'm just telling you. So such type of contracts are future contracts. But these contracts, since they are traded, don't consider them as investment or trading products. They are not investment or trading products. They are simply commodity derivatives. Why they are not investment product? Let us know the reason. The first reason why they are not investment product, they are leveraged. When we say the word leveraged, it means that when you have to buy a contract, you don't have to pay all the money. Suppose you are buying 10,000 quintals of rice. You don't have to pay the money of 10,000 quintals of rice then and there when the contract is signed. You buy a very small amount of money. For example, I am saying you pay 10 rupees per kg for something which is 100 rupees or 10,000 rupees a kg. So the contract value will be very high. You are keeping very low amount. So what happens is this makes the contract very risky. Now you will ask me a question, why this becomes risky? I am buying it, I am just putting 10 rupees and buying a commodity worth 10,000 rupees. It is so profitable. If the price goes up, I make money. My question is, suppose this commodity falls by 1%, the market price. The market price after you have gone into contract and you have bought 10,000 rupees worth of commodity at 10 rupees and it falls down by 1%. So 1% of this is 2 zeros. If I remove it is 100 rupees. So all your capital which you had kept got eroded. Not only that, you will have to pay 90 rupees more to the stock exchange, because anybody who has exited the contract because of you will need money, because you are exited at a price which has happened because of the fall in the commodity value. So at a price you will have to pay 90 rupees to sustain, or it will get cut at 10 rupees. We will not get into that detail for you, because for mutual fund you don't have to understand the nitty-gritties of trading. But from my point of view, which I want to tell you is that since you will have to pay 90 rupees more to book this loss of 1%, that's why it is called risky. Since it is leveraged, from 10 rupees you buy 10,000 worth of commodity, that's why it becomes risky. This was the logic of explaining you this. They are short-term contracts. These future contracts in commodities are of a duration of 1 month, 2 months or 3 months. So they are of short-term duration. And investment, when we do, we look for long-term outlook. You have bought some stock today, you want to hold it for next 5 years, for 10 years, for 20 years, for 30 years, at least 2 years, 3 years. That's the type of horizon you keep when you get into mutual funds. So not before that you'd want to exit from your investments. So that's why, since it is short-term contract, it lives only for 3 months, that's why we do not consider it as an investment product. So these are the reasons why commodities derivative contracts are not considered as investment product. The other aspect of commodities which I want to discuss is bullions, which is the gold and the silver, which shows a typical characteristics different from these consumption characteristics which all other crude oil, electricity, pulses, food grains show. We will discuss about them in our next video. This is all for this video. Thank you.